the Small Cap Power Expert Interview featuring Michael Giordano. Today in the studio, we are pleased to have Michael Giordano, Vice President of Investments with Stone Asset Management. The company is an independent 100% Canadian-owned asset management company, providing investment expertise and investment fund management to mutual funds, flow-through limited partnerships, investment funds, endowments, private clients, and corporations.
All right, thanks, Mark. Once again, I'm Mike Giordano from Stone Asset Management, and I've been with Stone Asset Management for 9 years now, and I focus on the resource sector. So we run both a resource fund as well as flow-through funds on a yearly basis, and I help out with the resource components of our other funds. There's a total of about $700 million of assets under management, and resource, we believe, is a key component of the Canadian investment landscape.
As a portfolio manager, what do you look for in early stage companies?
As a portfolio manager, I think experience of management is key, as well as the underlying assets. So we like to meet management to make sure that they know the category that they're focused on, they know the underlying commodity, as well that they have expertise in getting prior properties up into ultimate production. So whether it's the oil and gas side with experience of getting the oil and gas out of the ground, or on the base metal and precious metal side where they look at new properties and bring them onto fruition.
Given the resource sector's poor performance during the past few years, have you been allocating more funds to other sectors, or have you been buying some of the beaten down mining and oil and gas names?
I think the way to play the resource sector in an environment of falling prices is to look at those industries that will benefit from volatile commodity prices. And I'll give you a couple of examples. One thing we look at is the chemicals companies. They benefit from lower nat gas prices because that is a key input in the manufacture of plastics, for example. So we have companies like LyondellBasell in the US, as well as Axial Corp. Another area to look at is the infrastructure companies that have to move the energy from point A to point B, and regardless of the price of the underlying commodities. So we like companies such as TransCanada, or even the Interpipelines of the world, and Gibson Energy. So those companies will benefit regardless of the price of the commodity. And as well, we also like the midstream operators who are challenged and have to extract the various liquids out of the liquids that come out of the ground. For example, Gibson Energy once again, or Keyera.
What effect will the ceasing of quantitative easing have on the gold price?
I believe it's a negative on the gold price. There was a lot of easy money that was flowing into the emerging markets, and that's been basically taken away. And with money flowing into the US dollar, then there's less need for the financial security of gold, for example. Another negative is the fact that there is no inflationary pressure in the system, and that would be a negative, as gold was traditionally seen as a hedge against inflation.
Why do you think the price of gold has performed so poorly recently?
Well, I think the main driver is the strength in the US dollar, as the US dollar is seen as the best of all evils in the world currencies. Interest rates are seen to start increasing in the US, whether it's mid-2015 or a bit later. The focus is on the fact that quant easing has been eliminated, and the interest rates will ultimately go up. So money flows are going back into the US dollar, and that is a negative for the gold price, because investors have an alternative of buying gold or buying currencies, and they're currently buying the US dollar. And another negative is, once again, the inflation is nowhere to be seen globally. So in fact, there's deflation fears. So what was once a hedge against inflation certainly is not there at the moment.
So where do you think gold will close in 2014?
Yeah, well, gold seems to have broken the key level of 1180, and so currently trading at about 1165. So, you know, mid to long term, it's a bit of a negative on probably 1100, but I think by the end of the year, it should hang steady at about 1150 to 1200. You know, the damage has sort of already been done on the gold price.
Can you tell our viewers about any small cap stocks you like at this time?
Well, I'm going to focus on a couple small cap stocks. One is in the nat gas space, because oil is kind of unpredictable right now. So there's a company called Advantage Oil and Gas. It's $780 million market cap, nat gas producer out of northeast BC. They're in the key Montney Glacier area, and this company is producing about 22,000 barrels per day of oil equivalent on the nat gas side. They're highly liquids rich, and they're looking at growing that to 30,000 barrels per day. And this is at a very cheap cost of $2 per MCF. So current prices are $4 an MCF, so they have a lot of leeway there. Their debt is reasonable at only 1 time debt to cash flow, and the balance sheet is pretty healthy with a lot of room on their borrowing line. So I like that company. That's our first pick. And on the gold space, I also like a company called Lakeshore Gold. It was one of my picks before. This is a gold producer out of Timmins, Ontario, with their Timmins West and Ball Creek mine that they're currently producing out of. And they got exploration properties out of a property called 144. So there's a company that's currently producing about 142,000 ounces of gold per year at a very cheap cash cost of $600 per ounce and an all-in cost of about $850 per ounce. So if anyone could withstand these lower gold prices, certainly Lakeshore is there. So I like the fact it's got excellent management team, they're growing production, and they got very low cash costs, which is what we need in this declining resource environment.
And finally, if you had just one piece of advice for resource investors, what would that be?
Well, the one piece of advice, or several pieces of advice, is the resource sector is volatile. So you really got to be in there for the long term. And prices are volatile, therefore it's best to diversify across various sectors and stick to large cap liquid names that are going to sort of provide the cash flow and the dividends to weather the volatility. And you sort of anything on the speculative side, I would maintain to say under 2% of your total portfolio. Otherwise, the volatility has been around in the past and will continue to be around for forever, really. So this is a sector that we want to be in because the world needs our commodities for consumption. As the global populations grow, this will create demand for oil, gas, as well as copper, nickel, and other base metal resources. So got to be in there for the long run and sort of hedge yourself by being diversified right across the various sectors of the commodity space.
Thanks for taking the time for today's interview, Michael.
Thank you.
Keep up to date with all of your favorite small caps. Subscribe to our free newsletter and get daily investment ideas, breakout stocks, momentum gainers, expert and analyst stock picks, and more. Smallcappower.com, investing ideas and research.